नमस्कार साथीहरु, वेलकम अल अफ यु टु माई च्यानल। आजको डिस्कसनमा हामी चाहिँ अकाउन्टिङ ट्रिटमेन्ट फर द बन्ड भ्यालुएसन भनौं या यु क्यान से दैट बन्ड प्राइसिङ या इज वान अफ द इम्पोर्टेन्ट डेट इन्स्ट्रुमेन्ट्स को बारेमा छलफल गर्नेछौँ साथीहरु चाहिँ। एन्ड आई बिलिभ दैट बेस्ड अन द ओभरअल डिस्कसन यु वुड बी इन पोजिसन्स टु एटलिस्ट अन्डरस्ट्यान्ड द ओभरअल कन्सेप्ट अफ बन्ड इटसेल्फ, bond pricing, its accounting treatment, including the how we can say that yeah this bond is issued at par, premium or discount, and the lastly I would be discussing about the how we find the carrying value. That is the basic you can say that lecture and discussion contents for today. Now let's move to the is its background of the debt instrument. We say that bond is the debt, one of the important debt instruments which normally we found practice in the developed countries. However, bonds don't seem to be popular in developing countries like Nepal, like as Bhattacharya stated in 2013. And the next one is that friends, that is all about the coupon interest payment. It could be like your annual, semi-annual, yeah, quarterly basis, but most of the companies usually practices is a semi-annual coupon payment. And from the company perspective, friends, we need to understand here that there is a good advantage of using the debt financing as compared to equity. One of the term is that as a debt tax shield, that is the tax benefit. We can say that when we use the debt financing, one of the option is like you use the bond in the context of capital structure management, and the no devolution of the control, yeah, specific payment of the interest. Now next one is that regarding the corporate bond, friends, corporate bondholders are paid regular coupon interest, and the company will redeem the maturity value at the maturity, right? Maturity means once the bond mature, and at the maturity period company will redeem your value of your investment. That is the point. And as an investor, friends, that's you would have a stable return from your long-term investment. And the next one is that bond having the convertible features. Let's see, in the area of corporate finance we normally discuss the things that is a corporate bonds have a conversion features, we say that, which could be converted into common stock instead of redemption. That is the case. But remember, once the company, let's say the become a bankrupt, yeah, in case of we say that firms solvency, you can say that a bondholder has a priority of the claim to the firm's assets before the preferred stock and the common stockholder. That is why we say that if you remember income statement, like your earning before interest and tax less, we say that interest on debt, there is then you can find the earning before tax, then we pay the tax, like that. Okay, then you would have a earning after tax. That is why we say that in case of firm solvency, bond holder would have a first claim on the company's assets in case of liquidations, yeah, firm solvency. That is the point. And now let's talk about the features of the bond. That is, it could be secured bond which backed by the like your collateral, and normally bond is always secure. And in case of unsecured debenture, that's which backed by the not the collateral here, but is backed by the credit worthiness of the issuers, is the rating of the company, like that. Now what about the bond indenture, friend? Bond indenture is all about we see that it is also known as debenture trust deed. Yeah, you can say that is a legal document which clarify about the rights and obligation of the debenture holder and issuing company. And as I explained earlier, friends, that is the coupon interest. Coupon interest in the when you are let's say the going to buy the bond, yeah, you are investing in the bond market, then you company will provide the coupon payment. And coupon payment is nothing, that is the coupon rate into face value of the bond. That is the face value, usually we say that the 1000. And the maturity value is all about your, let's say the company, let's see the invest issue the bonds for 5 years. So 5 years is our maturity period. Okay, now next could be the trust deal. In case of let's see the company, yeah, issuing company, not paying the coupon payment as I stated, then in that case trustee would work as a representative of the bondholders. And as I explained earlier, friends, that is all about the debentures are mostly redeemable. We say that, and they are generally redeemed on the maturity period. And as an investor, you are expecting the certain rate of return, which is called the YTM, yeah, required rate of return. And convertible bonds, I already explained. And callable bond, sometime as for long-term financing needs, company issue the bonds. But when the company has surplus funds, in that case, before maturity too, just for example, if the maturity period of the bond is, let's say, the 5 year, then sometime even at the end of third year, the company could call the bondholders and redeem the value. That is the case of the callable bond. Okay. Again, in the area of corporate finance, we discuss in detail. And what about the zero coupon bond? It's also known as deep bonds and don't carry any periodic interest payment. That means zero coupon bond is issued at discount and redeemed at the par. That is the point that you need to understand here. Now, main point is that question is about how we find the value of the bond. Yeah, we can say that intrinsic value of the bond. Yeah, as an investor, what price we are willing to pay. Then this basic equation that you need to understand here, that is the bond price equals to present value of the coupon payment, one cash flow, plus present value of the your par value of the bond. This coupon payments, remember, the company will make the annual coupon payment. It could be semi-annual, but it is same. So we have to multiply with the annuity. That is the coupon payment into PVI of a present value interest factor annuity, R percentage n year, plus and simply face value. Yeah, face value is say that par value of the bond, that is the 1000 into PVI of R percentage n year, because the company will redeem the value of your investment one time, while company will make the payment of the coupon payment. That's as each time period is annual case. Okay, that is the case. But remember, friends, that is the point is that when R increases, your that is the interest rate increases. Yeah, you can say that required rate of return increases. Then in that case, value of the bond would go down. That is the, you can say that there is inverse relationship between these two variables R and the PV. Now, what about the factors affecting bond price? One is the face rate of interest, which is also known as, friends, that is the stated rate, yeah, nominal rate, you can say that, yeah, contract rate, whatever, yeah, coupon rate. And second one is the market rate of interest, which is called YTM, yeah, effective, yeah, bond yield, you can say that. A bond issue price, yeah, that is the present value of the bond today. As I explained earlier, this is simply the present value of annuity of the interest payment plus present value of the principal amount, yeah, face value of the bond. Now the question is about, friends, that is all about key from the company perspective. You would have option of either we finance with the bonds or stock. It depends on your overall financing decisions. Okay, so that, for example, let's see the issuing a stock. When the company issue the stock, then there is no liabilities created, that is no liabilities here, and incur no expense, interest expenses. In case of a stock, the company will pay the dividend, less risky to the issuing corporation. Okay. Now, what about the notes or bond payable? We say that it does not dilute the stock ownership or control of the corporation. That means bondholders are not entitled to interfere in the management. Okay, so we can say that that is the basic reason it does not dilute the stock ownership or control over the corporation. Usually, we say that results in the higher earning per shares. Earning per share is simply is the earnings available to shareholders by number of share outstanding is increased. That is the part. Anyway, that is all about your financing decision case. Now let's move to the question is about how to find the bond value. Now let's move to the discussion on this important question. For example, let's see this. Suppose the IBM company issued the bonds on Jan 1st 2009 with the coupon interest payment is 6.375% is coupon rate, face value is the 1000, with the maturity period, yeah, we can say the maturity time period is, that is the 5 years, and given your required rate of return on investment, that is the YTM, is 8%. Now the question is about whether What would be the value of the bonds? First case, whether this bond is issued at discount or the premium, and record the journal entry. And what about the unamortized discount and the carrying value? If this is the case of quiz question, friends, then probably we don't have time to solve the questions, okay, in detail. Then look at your given information. Important point is that when coupon rate is lower than our required rate of return, just YTM, then in that case we say that the bond is issued at discount. In that case, your value of the bond, that is the V0, you can say that present value of the bond today, will be lower than 1000. That is the case you need to understand. Now let's move to the discussion in detail. Like we could draw this IBM bonds timeline like this. We have a 5-year period, that is 2009, 10, 11, 12, 13. Now each year the company will make the payment of 6.375 percentage of 1000, that is called the coupon amount. 63.75, 63.75, again 63.75 up to 5 year. As I explained earlier, when our series of the cash flow, like I'm talking about from the company point of view here, yeah, from investor point of view, you will be getting the coupon payment of this 63.75. So this is the equal cash flow. So that is the basic reason we need to, this is the case of, we need the annuity for 5 years. You can take the reference of annuity table. Yeah, you can use the formula. Okay. Now the company will redeem the value together with the coupon payment. That means is the one time. So we see that what is the present value of this value. So once you add it, then this value you will get it. Okay. Now let's move to the overall calculation part. As I discussed earlier, this is the present value of coupon payment plus present value of par value of the bond. Like this is 63.75 into PVIFA 8% 5 year, and this is the M. M is our 1000 here. You can use the 1000 by the way, $1000. And this is formula of PVIF is that 1 by 1 plus R power 5. R is our 8%. While in case of PVIFA, that is the 1 minus 1 by 1 plus R power n whole to the power R, we say that. That is the equation. Yeah, you can use the annuity table directly and you will find the equation at the header of the annuity table. Now based on this calculation, you can say that as this value, that is a $935.12 is lower than 1000. So that is the basic reason we say that we can conclude that this bond is issued at discount. Okay. Now what about the journal entry? Yeah, we can say that accounting treatment. So on this issuance date, January 1st, 2009, friends, yeah, that is we say that cash would be generated by the company per bond I'm talking about, that is a 935.12, and that's a discount on bond payable is simply 1000 minus this value, so 64.88, and to bond payable is our 1000. You can simply show it's in accounting equation 2. In accounting equation we say that cash is 935 while L is bond payable 1000 less discount on bond payable. This is the way we could show its impact in accounting equation. Now if the question is about what about on the maturity date, like 31st December 2013, so bond interest expenses is 63.75. It will be debited as per the nominal account rules of accounting, right? And the bond payable is 1000, so the cash is to 1063.75. This way we record the journal entry. Now the important question is that as I explained earlier, by looking at your given information, how we decide, yeah, this bond is issued at premium, discount or the par. When our market rate, if the market rate equals to face rate, market rate means that is the required rate of return, yeah, YTM is equals to coupon rate, then that bond is issued at par value, yeah, face value, you can say that. That means if 1000 is the par value, then your V0, that is value of the bond today, will be also the 1000. Okay. Now at the same time, if we say the market rate is greater than face rate, yeah, face rate, market rate is like greater than face rate, then that is the issued at discount. Okay. Now what about the third case? If the market rate is lower than face rate, that is the coupon rate, I mean to say that is the issued at premium, we say that. This way we could simply what I discussed today is all about how we value the bond, how we record the journal entry, how we decide about whether this bond is issued at discount or the premium case. Okay. In next class, I will next discussion I would be discussing about the case of the bond amortization. But if the question is about what would be our carrying value, okay. Now, what would be our carrying value in this case? The carrying value is simply you have to understand here, since this bond is issued at discount. For discount case, carrying value is simply we say that face value minus on amortized discount. Remember, in on amortized discount is that this is we have a 63.75 is the discount here. Okay, this is the on amortized, we say that. So the carrying value would be simply 1000 minus 63.75. This will be 93512, which will be reported in the balance sheet. Now in the next discussion, I would be discussing about how we could amortize the bond premium or the discount by using the effective interest method, friends. Okay friends, these are the things that I would like to share today. If you really like this content, please like, subscribe, and also share my channel, that is Finance Guru Pawan Kumar. Thank you all of you for watching this video. Please take care all of you. Thank you.